Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Tahli, Cavagnino, how are you?
Yeah, I'm good. How are you?
I'm very good. Thanks for stepping up to the plate yet again.
Always pulling through.
You know, you're just reliable, you know? Here in the Melbourne office, we're getting some Q&As done and we're just catching up on things. So today we've got questions about shares and tax time because we've been doing a bit of that lately. What would happen if you passed away with some shares? Do your kids pay tax on that? What happens? How to find a good financial advisor or accountant? And also, if you're young and you own ETFs, do you actually need to rebalance your portfolio like everyone talks about? So we'll get to those in just a moment. But firstly, to you, what have you been working on?
It's been a busy week. We're not through the whole week yet, but a lot going on. Gemma and I are working on an exciting article at the moment, speaking about women in financial services, or more the lack of women in financial services. So that's been interesting to dig into. We sent a survey out to the network just to get some feedback on lived experience, and some of it's been pretty disappointing, I say.
Oh, really?
Yeah. Just in terms of like, in 2025, what is still occurring in the space. But yeah, stay tuned for that because that'll be an interesting write-up.
Yeah, cool.
But yeah, a lot of client work this week as well, which is exciting. We're also bringing on a new staff member to the advice team next week, which is super exciting.
That's great.
Yeah, can't wait to have her on board. So all good things, yeah.
Cool. It was interesting. We went to an event last week, which you know about. I won't mention it here, but we went to an event last week. It was a fantastic event here in Melbourne. And on the way in, we were thinking about how many women would be in the room. I don't know, maybe I was optimistic. I was like 30%. And then someone else on the team was like 10, and then there was 20. I reckon it was like 10 to 20.
Yeah, wow.
Which is... obviously that's just, I guess, generally disappointing.
Yeah.
It's absolutely no issue with who put on the event. They try and they do an amazing job, but it is what it is, right? That's what the makeup of predominantly the investing side of our industry, which we could do a lot more on. So, and I know you do. So yeah, it's one of those things where hopefully by bringing not just awareness to it being a problem, but also just awareness to some of the exciting career opportunities that are in the finance industry, I think that will, I'm optimistic, I think it will improve.
Yeah, and I think that's kind of what we want to focus on more so with the article, because when women in the space are reading those personal stories and reflections on what's happened to them in the industry, like it's not really a surprise for any of us. So we want to focus more on like what happens next, because we are all aware of what's happening and the lack of representation of women in wealth. But now it's like, why is that happening? Is it is it a problem with the initial attraction to the industry? And is there a lack of education early on in the piece around promoting financial advice as a viable pathway? Or is it more around midway through the career and the lack of support at that point in time that causes people to drop off? Interesting. I think probably a bit of both.
Interesting. One thing that was really positive from the event was that when you walked into this beautiful room, there's obviously they say 80% of fellas in the room, and they're all in the same stuff. You know, they got the same jacket.
The navy blue suit.
This is coming from a guy who has no fashion sense whatsoever. So keep this in mind. They all look the same to me, but there could be a $5,000 jacket and a $5 jacket. I'd have no idea, right? So they all look the same, right? They got the same boots, the same pants. But then there's the ladies in the dresses, and they're floral and they're amazing. Yeah. And it's just thank goodness you're here because, like, seriously. But it was like, we actually met some really great people, like lots of entrepreneurial people, lots of new businesses as well, like lots of female founders in the finance space as well, which is great to see. Lots of them making use of like more social media, more digital communication to grow their business, which is really innovative, I think, and really positive. So no, that was really good to see. So we're going to answer some questions as we always do here on the Friday morning show on the Australian Finance Podcast. And that comes with it a beautiful thing, which everyone looks forward to every week, Tahli, which I have this on authority, which is the general advice warning. We don't know your needs, goals, or objectives, so be sure to speak to a financial planner, like the one sitting in the room right here, if you need any type of personalized financial advice. So if we answer a question on the show, because we don't know your needs, goals, or objectives, you should consider it as general in nature and don't act on it until you've spoken to your advisor. If we mention things like like super funds or brokerage accounts or ETFs, they come with something called a PDS or product disclosure statement. Really good that you read one of those before you invest or before you make a change. It tells you everything you need to know about what you're about to get into. Finally, we don't have any questions on insurance today, but I get a bit like a tingle down my spine every time we talk about insurance. So just in case we happen to bring that up, don't change super funds or don't change your insurance until you've got proper advice.
Okay, the first question today comes from DIY Debbie. She's asked, I use dollar cost averaging to buy ETFs every month. I do my own tax and all of the info has just fed into MyGov at the end of each financial year. Is there something else I should be documenting apart from what is already tracked on my brokerage account? If I ever sold shares, would that info just feed into MyGov as well? I prefer to do my own tax now. So much of it is automated and I'm cheap. Fair
enough. I like cheap. So first of all, we did have the ATO Deputy Commissioner on recently, and he talked about how MyGov or the ATO portal is a great thing if you set it up and you have all your bank interest that goes in there, dividends from shares and so forth. He did say, however, that it does take quite a few weeks for the final settlement. So if you're the type of person that rushes out and you're like, tax return, let's do this on July 1, it probably won't be accurate. So that's the first thing. Another thing he really stressed is that you should double check all the data.
Yeah.
Because it's often not, I don't want to say that it's not accurate, but it's just double check it because you are responsible. Now, as for capital gains, which is the other side of things, if you sell a share for a profit or you sell an ETF for a profit, that won't go in. You have to do that yourself, either with your brokerage account, a spreadsheet, or a third-party tool. Like we did an episode with the Navexa founder recently, which was hugely popular, like 30 to 35,000 people. Navar shares the office with us now. And he explained the real intricacies.
Yeah.
I would just say generally, Tahli, and I'm curious to hear your thoughts on this, I would just say generally, use the ATO MyGov pre-fill service, double check the numbers. If you have more than one brokerage account though, or if you switch brokerage accounts or you want to optimize your tax return, you might need to get a bit more sophisticated than just pre-fill.
Yeah, I would agree. I think the other really important thing is the time frame piece, because some brokerage accounts won't issue your end of financial year tax statements until like September.
Yeah.
So yeah, rushing to get your tax return in is probably not going to end well.
Yes. And then another thing is if you see, check with your accountant, but I'm pretty sure the fees that you pay to an accountant are tax deductible to prepare your tax returns, your income tax returns. So there's a benefit, like even if they charge you $250, there might be a benefit there. You might also be able to slip in a couple of questions in that hour-long block that they give you to just get a couple of quick-fire questions off that you want to ask about so you know for next year. And finally, it is. I think it's really good. I think accountants pay for themselves.
I agree. Yeah.
Like I think that it's a bit of a falsehood that if you do a cheap job, you'll get the same result. I think accountants do a really good job of justifying their fees.
Yeah, I think like we all love DIY. But I think the cost for an accountant, if it's a few $100s to have a tax return completed for you, have that peace of mind that it's all above board, get maybe some deductions in that perhaps you didn't think about or didn't want to do the math on, and make sure all of this sort of thing is input into the ATO correctly. Yeah, I think it's a bit of a no-brainer. But in saying that, if you are going down the DIY pathway, just make sure you're keeping a hold of your records as well. 5 years is the general.
Yeah, which is a long time. Like in that episode with Navar, there was 2 extra things. If you don't want to watch that Navexa episode, there were 2 extra things. If you own ETFs, there's this new thing under the new tax reporting regime called AMIT cost-based adjustments, AMIT cost-based adjustments. The reason why, as you know, Tahli, people need to wait until like August, September to really do their tax returns is because ETFs and managed funds can take 2 or 3 months to calculate your tax position. And they send you what's called an annual tax statement. It's got a bunch of different numbers that you can use to do your tax or you can hand to your accountant. But one of the new things on there is something called a cost-based adjustment. Because of, I won't go into it too deep, but because of the way an ETF is constructed, what you get in income and what you sell at a profit for is not all of the taxes that are either to be paid or to be kind of to your benefit. Make sure when you have that tax statement and you understand the different components on it. But Navar went through that. And then I guess, so there's a timing element, but there's also just an accuracy element. The ATO wants you to be accurate. Check out the ATO podcast we did recently. It's just like in the last week, and the Navar one as well. So the next question comes from, I'm spending too long trying to work out a name, so this will do.
Love that.
Who says, early in accumulation, let's say someone in their 20s or 30s, this is strictly hypothetical, of course, when/how often and why should someone be rebalancing their portfolio? Let's say a person was investing in like IVV and A200, they might grow at different rates, sure, but if one is growing faster, why pull that out to place it in the other one? I can understand rebalancing later in the game, but struggling to understand rebalancing earlier in the piece. I think if we stitch a bit of this question together with the first question, Tahli, this might be interesting. So they're saying early in accumulation. In the first question, you read out that DIY Debbie was saying, I use dollar cost averaging to buy ETFs every month. Most people early in their life are dollar cost averaging. So I'm curious how you think about rebalancing. Maybe, I know you deal with a lot of like pre-retiree type of clients, but just generally what you think of this question and maybe just your overall, I guess, ethos around it.
Yeah, I think rebalancing is an interesting one that everyone has their own strong opinion. There's very little grey area with this one when you speak to most people. I think rebalancing is important, obviously, because when we're looking at creating financial plans for people, we try and take a little bit of the emotional biases away from the overall long-term investment outcomes. And part of that is to automate parts of the process. So rebalancing, from my perspective of more of like a overarching financial advisor view, can sometimes eliminate rash decisions that are made in the heat of the moment, where someone might think, oh, I want to put more into this market because it's performing really well right now, and ignore the potential cost to buy in high.
Yeah.
Or it might be, oh, this particular sector is underperforming, so I want to sell out and put it over here. If we've got the set allocations to each asset in the portfolio and we can use rebalancing to adhere to that over the longer term, then I definitely see benefit. But in saying that, obviously there's tax implications. So it's kind of striking that midpoint of not rebalancing too frequently with making sure things don't get out of hand.
Yeah, I think that's a really good way to frame it. Like there's no one necessarily right answer, but it's just having those guardrails.
Yeah.
Like we know that the United States stock market, in this case IVV is what they've said, has done really well. It's done better than the VAS, the Vanguard one for Australia. And that has been the case for like 10 to 15 years. But there was a time like in the early 2000s when it was the other way around. So we don't know necessarily what the future holds. And that's one of the benefits of rebalancing is, or just having a broad kind of structure. I will just double click on what you said is that having a plan gives you the confidence. If you just let it run wild, then you may never know when is the right time to do something. So just having a plan is probably better than having none.
Yeah.
So we adopt it for Rask, we adopt a 10% kind of buffer range on, you know, if it's out of balance 10%, then we'll make a decision to rebalance. But one of the things that we also do, particularly with our Rask Invest service, is if you're a dollar cost averager, you don't need to rebalance that often, especially if you're earlier in your investing journey, because you just use the extra money that you're adding every month to go into the one that's more underweight. Sorry. So you could say in this case that its VAS is less than it would be. You could just put more in that. That way you're not selling a winner and incurring tax. You're just adding more to the one that needs a bit of a top up.
Yeah, that's a really good point.
Yeah. And there's one extra note I put in here that I wanted to air out is we recently did a big rebalance for our portfolios. And the reason we did that is our Rask Invest service had only been going for 12 months. And what had happened in that time, it started off really strong and the performance was really good. And then Trump came in and basically the portfolio got smashed. So what we determined is that across the hundreds of investors, that most of the investors were at break even or slightly below. So what we thought, is if we're going to make a change, now's the time to do it. Because one, we're at the bottom, hopefully, of this little correction that we were in. And secondly, there wasn't much tax. So it kind of made a lot of sense for us to top up or to rebalance at that time. So that's what we did.
Yeah.
We're really happy with that. Okay. So this is another good question, which I reckon you're better placed to answer than me. Jinx says, I'm about to invest in some ETFs for the first time, and I'm thinking long term. That's good to know. They say, I am wondering, in the event of something tragic happening, what are the implications of my children inheriting them? For example, if I passed away and my shares were worth $10,000, would they incur tax of some kind? Would the investments lose value? And would holding the investments in a trust be a better option? Let's just start with the first one, which is, would they incur tax of some kind, generally speaking? So
we're pretty lucky in Australia that, for now anyway, we don't have an inheritance tax, so to speak, that, different rules apply to superannuation, which we probably won't go into. But generally speaking, if you hold a personal investment portfolio under your name and you were to pass away, your children or whoever you've nominated to receive your estate would just receive that portfolio. Okay. So there wouldn't be tax implications on the transfer of ownership at that point in time. It would only be if the kids, say, inherited that portfolio and then were to sell the assets, which would just be your regular tax implications.
That's good news for the kids.
Yeah, so that's a plus. The thing, though, that we look at a lot of the times when we've got people perhaps in that, early family growth stage and they are starting to accumulate a pretty reasonably sized pool of assets is whether or not you want to pass down a huge portfolio of assets to kids under the age of 18 at that point in time. Right. Or whether you want to, inhibit a bit of control on the way that they receive that inheritance, which is where things like a testamentary trust can be super useful because you can set, the guardrails of how your children might have access to that money. Particularly thinking, they're probably unlikely to know what to do with ETFs if they are quite young. Yeah. We were speaking before, even my nan, typical of her generation, I guess, had no education on finances in any regard, really. And she inherited a portfolio of direct stocks from my pop when he passed. And had no idea what to do with those. And she ended up just selling out of them all regardless of tax implications because it was too overwhelming and confusing, whereas something like a testamentary trust or a TT, it can control a little bit around that. So you can specify how much that beneficiary receives, or if you would like to specify a certain age where, for example, once your kids turn 25, then they've got ownership and control over those assets. Yep. Sorry, I went a bit off track there.
No, that's good. So this is really good. So because there's two types of trusts that this person is probably confused about. The first one is like a family trust, which is a typical trust that you see when someone is living. That's the family trust. And you can hold assets in a family trust. We've done a whole guide on this, by the way. But the other one is a testamentary trust. It's like my will and my testament, right? That's established when someone dies, but only after they die, not when they're living.
Yeah, correct.
Right. And how does that get created?
So that needs to be written into your will. Okay. It's really it's like this hypothetical trust that is only written on paper, but it's not actually in effect. And then upon passing, it becomes established.
Okay.
Yeah.
And then so what happens, so just broadly speaking, is say I pass away and in my will I have a testamentary trust written into the will. After I pass, the assets that are governed by my will, like my shares or even if I had investment properties or whatever, some cash, whatever, they all go into this thing called a testamentary trust where they're held. And from there, they can be invested on behalf of my kids until, like you said, until 25 or until 18 or until whatever.
Yeah, exactly.
Okay,
yeah.
cool.
Yeah.
So that's a really good structure. So that where it comes back to everyone just getting your will in place and understanding what are the different types of arrangements, right?
Yeah, super important. I think a lot of people neglect that. It's, obviously not the most fun topic to discuss, but having a valid will is so important at all ages. Like I think a lot of people don't really think about it until getting to like their 50s, but unfortunately we do see instances where it is required earlier.
Yeah.
And if you don't have something like that put in place, like you're just kind of leaving things open to the state trustees to use their discretion as to how your wealth is distributed.
Yeah, that makes sense. So you can contact estate planners. There's plenty of good literature online around this as well. The problem with the first option, which is the family trust, as the way I see it, is on average, I would expect that a family trust tax structuring setup thing, I only suggest that people should consider them if they're going to earn a lot of money or they've got a lot of assets, because they're about $4,000, I would say, give or take, to set up. And then there's ongoing costs as well. So if someone is worried about $10,000 in total, there doesn't really seem to be a big cost-benefit analysis right now. Maybe in the future.
Yeah, I agree. I think it's something that's catching quite a bit of tailwind on FinTalk.
It is. It's particularly around property as well. It's like as it relates to property and buying properties.
Yeah. It's definitely an attractive, trendy thing at the moment. But yeah, there's...
Why are people interested in family trusts all of a sudden? Like they've been around for I feel like centuries.
I think, and from what I'm hearing too, there's a lot of misconceptions that it's just this flat tax, concessionally taxed environment. And like I've spoken to people in the past as well that haven't understood that it's really only beneficial if you're distributing to numerous people and you're going to take advantage of lower tax brackets for different people that you want to distribute to. For example, I've spoken to one person who wanted to set up a discretionary family trust just for themselves as a single person.
Well, then
and distribute back to themselves and still pay the same tax rate.
Then it's just going to cost money unless somehow they get a partner or kids in the future or they set up a bucket company. Anyway, we're going down a rabbit hole here. One other thing that I'll just completely throw in the mix out of left field is that if you knew you were going to die, you would go and speak to an estate planner now, and you would speak to a financial planner now. The reason is twofold. One is you would be able to, if it's a financial planner, you would have someone that can manage your estate for you on the financial side if you feel like your family couldn't do it. And the second reason is the estate planner with the financial planner might be able to suggest things that are like completely tax-free in totally different ways.
Yeah.
There are many different tax structures. A family trust is not one of those, by the way, that may be able to help people in that regard. We deal with a lot of people on the receiving end, it's fair to say, because a lot of the listeners on this show are of an age where they're receiving inheritances or big gifts or whatever the case might be. So we deal with people typically after the fact, and that's also a very emotional time to be dealing with money, and particularly if it's your first time dealing with an insurance payout or a settlement or some big sum of money. Having a relationship formed with your parents or through your parents or whatever before that happens is probably a really good step to take. If you're a parent or a grandparent listening to this, maybe it's saying to your child or grandchild that you plan to give money to, maybe like, hey, let's go see a financial advisor together, because that might be a way to help bridge the generational divide and understanding of what money means, and get some support, to be honest, as well. Final question is, what are some tips on how to find a good accountant or financial advisor? This is from Stinky Binky. Now, you have done a really good blog series recently, which we can refer people to, on how to find a good financial advisor. But if you wanted to just riff on this for a second, good accountant, good advisor, how?
Looks different for every person. I'm sounding like your classic person in finance today. Like,
it depends.
Yeah, it depends. Speaking specifically to a good financial advisor, I think, first of all, don't expect that the first person you speak to is going to be the perfect advisor for you. We really encourage all of our clients to have an introductory meeting with a range of different advisors to get a feel for the way that that individual business or person is going to give advice, because it looks different from person to person, business to business. So expect that. Technical knowledge and experience in a set of circumstances that mirror your own is really important. So asking the advisor to explain like who they work with, what their typical client looks like, what their typical solutions look like, and then the personality match or the communication style is really important as well. So understanding what the long-term relationship will look like with an advisor is really key, and whether or not you naturally feel like you gel well with the advisor.
Yeah, I like it. The other thing that I'd probably mention here is the very first housekeeping thing is make sure they're licensed.
Oh, yeah. Yes. Sorry, skimmed over that.
Check to make sure they've got a license. And a lot of people miss this because they think like all the worst stories you hear in finance are actually not from finance people. That's the great shame, is that the finance profession gets thrown under the bus for a lot of stuff that actually has nothing to do with us. It's just con artists or fraudsters or people that are just check that they've actually got a license first. There's a thing called the Financial Advice Register. So first things first, make sure they're on that.
Yeah. So you can search advisors up using their authorized representative number, which they have to list on their FSG, which is their financial services guide. So when you're speaking with various advisors, they will have a link to their FSG on their website. They legally must. So you can just copy and paste that number. The AFSL as well is a good one to look up, which is the Australian Financial Services License. And that will show all of their qualifications, whether or not they've ever been disqualified, which would immediately be more than a bit of a red flag, and the areas that they're actually qualified to provide advice on. So, yeah, super key. See if you can find like some reviews, whether it's online or through word of mouth. A lot of advisors, like, they're probably not going to give you previous client contact details and say, hey, call up Jenny and see what she thinks of me, because it's quite a deeply personal relationship. But if you can get some direct word of mouth feedback on the business, that's really important, because generally the ones that are doing the wrong thing, they won't be getting the good feedback that you kind of need to have before engaging with a business. Yeah. An accountant, on the other hand, you've wrote here that it's hard in all caps.
Yeah, well, I think it is. I generally think it is hard to find a good accountant.
Yeah, I agree.
I'd say first of all, is to know what type of accountant they are. There's a lot of accountants that only deal with business owners because their firm that they work for only has systems for business owners. And then there are ones that just do PAYG, like employee tax returns, like a H&R Block, and some of the other ones you would see most places around. And they're typically all right. Like if you're just looking for really simple, like if your tax affairs are simple, I would just say if your tax affairs are simple, but you're also an investor, so you're also like buying shares and ETFs and that sort of a thing, you could use one of those. Absolutely. But the other thing that I would say is maybe use a tool like ShareSite or Navexa, one of those tax reporting tools, because they have a lot of educational literature there. Because regrettably, not a lot of accountants do a lot of investing stuff. Yeah, because it's just not worth their time, like to figure out how much money did you make on CommBank? When did you get a dividend? Like, did you do a DRP, a dividend reinvestment plan? Did you not? Like, what is your cost base? How long did you hold it for? Like, that costs them a lot of money to figure that stuff out. So by paying for a subscription, you'll probably get a far easier tax return. Like even if you just, I don't know what Chef's Side of Extra costs. It might be like a few $100 a year and probably tax deductible, probably. I don't go and do it. And then what you can do is then just hand that to the accountant.
Yeah.
And say, this is what I've done.
Yeah, you're very right. I think it's one of those things though, right? Like you pay for what you get. So you can definitely do some very cheap, cost-effective accounting options. And I want to say it's somewhat similar in financial advice too, to a degree.
Yeah, it is.
But yeah, if you want to have like tip-top accounting, you're probably going to have to pay a little bit extra.
Yeah. There's you can use the, I'm just looking at it now, which is what I was just Googling as we're talking. You can find out if your tax agent is registered by using the Tax Practitioners Board. It's the same process if you were, looking for the ASIC advisor register. You can find someone like in your area, or you can search the register too. So it's interesting because we've talked about this on the show before. There are financial advisors who can talk about tax, but they're not accountants. Mm-hmm. So like yourself, you're a registered tax financial advisor. So you can talk about tax strategy, tax optimization, tax structures, tax generally, but to actually do the tax return, you still need to go to an accountant.
Yeah.
So you kind of want the A team in your corner as you grow your wealth, but that's how they generally work.
Yeah. I will just say as well, just quickly that, some accountants will, but a lot will not give you or go out of their way to be proactive on tax strategy. Like, don't expect your accountant to reach out to you and say, hey, have you thought about making additional contributions to super this year? Yeah. Most will not. Some do. But generally you kind of want the ideal structure. To toot my own horn is you have a advisor in place who's kind of like your project manager, and they can liaise with all the other professionals to make sure everyone's putting the right things in place for that one individual.
That's actually really interesting. Yeah. That's really interesting. I didn't think about thinking of them as a project manager, but that's kind of what it is, right? Advisor's kind of the project manager.
Yeah, because there's a lot of things that like we legally cannot do, and it's the same with like estate planning. We can talk about it and give you some recommendations and talk about the benefits of a testamentary trust, for example, but can't go and write your will for you. Yeah. I will still need to speak to a professional.
Okay, get the electrician to do that for you or whatever.
Yeah.
Okay, that's cool. So just to recap today's episode, write in with your questions is probably the number one thing you got to remember. We got so many questions in the last week. It's great. Like we've probably got more than ever before, to be honest. I reckon in the last week, no joke, I reckon we've had just through the actual official means, which is in the YouTube description or on the podcast player, at least 50 questions, I would say.
That's great.
In a week.
That's amazing.
And then there's all on Spotify, which we don't always have as much time to get to. On YouTube, on the Rask community is probably that we get the quickest response. But keep writing your questions in. We absolutely love to hear from you. And eventually we'll give you more and more free stuff. So just to recap what we talked about, using dollar cost averaging and the tax, not everything is always pre-filled, or if it is, just double check it. If your situation is simple, great. We've done 2 episodes recently, one with the ATO itself, and with Navexa on more capital gains stuff. Then we did a talk about, from the lovely questioner who wrote, I'm spending too much time trying to work out a name, so this will do. We talked about being younger and the idea of rebalancing and how just keeping costs in mind, having a framework might actually help you in times of uncertainty. But if you are dollar cost averaging, maybe topping up on the ones that are underweight is the way to go for most of the time. Jinx wrote in and asked about ETFs for the first time and kids' inheritance tax. Good thing is it's pretty simple if everything's in your personal name. Super assets, other types of weird tax structures we began to dive into, which we had to restrain ourselves. That obviously is a different thing. So if you're confused, just speak to a professional. Finally, we talked about finding a good advisor or accountant. My first protocol, check that they're on the financial advice register. If you're watching this video version of the podcast, there is actually a thing that's just appeared to show you what that looks like and how to check. And same with the Tax Practitioners Board for accountants. But it's like, what experience do you have? Asking the right questions, prompting them to be proactive a lot of the time too. So we love it when people come to us with the questions. And it just makes such better conversation. So there'll be plenty of resources in the podcast player for this episode, plenty of resources in the YouTube description. Tahli, as always, thanks for joining me.
Thanks for having me.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.